Our talk of the tape, is this snapback in stocks here to stay? What a panel. We've got Eric Johnston of Cantor Fitzgerald, Courtney Garcia of Payne Capital Management, and Brian Levitt of Invesco. Courtney, of course, is a CNBC contributor. Thank you all for being here. What's your take on this? I mean, it's hard to believe. Best week of the year. And like yesterday, we're like market alert, red across the street, sirens going off. What happened?
So we came into this week with the S&P. The RSI was about 31, which has proven to be a very good entry point from a short-term perspective.
Technical bounce.
Technical bounce.
Yep.
We also had, if you look at the last 2 weeks of April, post-tax day, seasonally, the last 2 weeks are also favorable. And then, of course, we were looking forward to mega cap tech earnings along with the PCE. And, the PCE was something that the market was concerned about.
Yeah.
And I think one of the things happened today, the print, when you look at it on an absolute basis, we think was a hot print. When you go look into
That's what I thought, too. And then
look into the details. Yes.
Seem to care.
Absolutely.
I thought inflation and the Fed were everything.
That's right. And I think, part of it was expectations that there was a concern that it could come in even hotter than it came in. And then clearly, obviously, earnings from Microsoft and Google were clearly a favorable, dynamic. But, this was really just a bad.
Can I hit on that point? Because that idea that you bring up, Brian, that inflation and the Fed are everything. Think about it, though. Nominal growth is strong. Right? Growth continues to be good. Inflation a little bit more elevated. I'd actually prefer strong nominal growth and less rate hikes than what everybody was expecting, which is weaker economic growth and more rate hikes. So we'll have to deal with inflation over time. I do expect it'll continue to moderate, but strong growth.
So would you care? Let me ask it a different way, because I'm out there. I've been on no rate cut island. Nobody cares what I think. Why not? I just put my vote in because I can, and they can't stop me from saying it. Do you care if we get any rate cuts this year?
I care most that tightening's over. So this conversation that the Fed might have to raise rates again, I am not in that camp. When the market was pricing in 6 cuts, it was a little out of whack with where the Fed was going to be. So we're getting closer to alignment. Do I care about the timing or the magnitude this year? Not really. I'm more focused on the fact that over the next couple of years, we're going to be in an easing environment with the yield curve normalizing. That's a good backdrop for risk assets.
Courtney?
Yeah, and I want to echo that. I think that's really what investors should be focusing on, is that the economy is still improving. The consumer is still strong with wage growth improving. Realistically, what you're seeing right now is even though rates are over 5%, many corporations actually readjusted their debt before rates went up in 2022. Many households have 30-year mortgages under 4%. So a lot of people aren't affected as much by these higher interest rates. And while wages keep going up and the consumer is still strong, that's how we're able to get through this period, even if rates don't come down.
But is the consumer still strong? There's a show at 7 o'clock. It's called Last Call. You're welcome anytime. All of you, by the way. We showed how all these consumer stocks, Ulta Beauty's down 20% this month. Walgreens, they got a lot of problems. They're down 18% this month. There's all these retailers where the stock market, Courtney, is acting like they're in trouble. Maybe they're unique situations. I don't know. Are you worried at all about the consumer?
And I don't think that's happening across the board, right? Because what's happening is people are affected by inflation. I don't think that you can discount that. But on the flip side, you're seeing like airlines and travel is still continuing to be strong.
Yeah, I think people are still going places, not buying stuff.
Which changed during COVID, and everyone said, okay, this is just going to be a certain cycle of this. Maybe that changed longer than people realize. So it's not the fact that the consumer's in trouble. They're just having to decide where those purchases are going. And so that's where, when you're looking to reinvest into the economy, which areas is the consumer going to continue to be strong in? You probably are going to see that experiences over goods for a little while longer.
I think the consumer is strong, but the consumer is also weakening. So if you look at savings rate, right, savings rate's about 3.5%. Still high, but it's at close to the lows, since the pandemic. Mm-hmm. High prices are still eating at the consumer,
They're borrowing
excess savings.
Nobody, $1.1 trillion in credit card debt.
Yeah, that was all.
Yields going. Nobody seems to care.
That was all Taylor Swift tickets.
Well, that's half of it. You're probably not wrong. And I know that debt as a percent of income, people are going to at me on the X, but debt as a percentage of income it's low and near all-time lows. But I know people, you're getting something in the mail, says, hi, by the way, we just raised your credit card APR to 24%. Thanks for being a valued customer.
But the consumers being helped out by their fully employed, net worth, right, between home prices, where they are close to the highs, equity prices at the highs and are still have that excess savings that's declining. So the consumer on an absolute basis is still strong, but I think directionally is what we have to look at, which I think is important and showing some incremental headwinds, and some of the corporates are.
So let's